Today we're going to look at how to use a whole life insurance policy to pay for college. We'll look at a very interesting case study that involves someone starting a whole life insurance policy to pay for college, and they plan on using it right now. So let's get on into it. We'll start by going over why people do this. Why would anyone even consider putting money into a whole life insurance policy as a means to pay for their child's college? Well, there's several reasons, but there are two very popular ones. The first is that the cash value in a whole life insurance policy does not always count as an asset if you're applying for financial aid. Now, of course, this depends on whether or not you qualify for financial aid, but you will see many college planners in the US utilize cash value life insurance for this reason. So that's the first reason as to why a lot of people do this. And the second, which is the big one in my opinion, is that the cash value continues to compound when I borrow against the policy. Meaning, I can put money in my life insurance policy, it earns interest, and then I use that money to pay for college. So what this means is if someone decides to fund a policy, borrow against that policy to pay for their child's college, and then they pay that loan back, they will see that their cash value is restored, plus all of the dividends and interest that they earned while the money was outstanding in the form of a loan. And also, they don't have to pay the loan back if they don't want to, in most cases. If I completely drain the policy, that would be a situation where I would need to pay something in order to prevent a lapse. So how does this work? Well, step one is I fund a whole life insurance policy, and the goal is to maximize cash value. Step two is that I fund a policy for a very short period of time, often 2 to 3 years. Now, you can fund longer. However, in experience, I have found that these shorter funding periods are very popular, and this is especially true if someone is looking to use this right now, meaning college tuition is either a present thing or it's coming up in the near future, and they're interested in seeing how this can work for them now, and they don't have a 5, 10, or 15-year runway. So after funding the policy to maximize the cash value, the individual will then use policy loans to pay for college. And the important thing to do if you're ever considering this is to review options, specifically illustrations, that show what things look like if you pay that loan back versus not paying the loan back at all. And I'll show you exactly what that looks like in a minute. So the case study we're going to look at involves a doctor who lives out in California. She's currently 54 years old, and her son just started school at USC. USC is not cheap. So the college tuition is about $100,000 per year, and she's already paid 1 year of college tuition for her son. So here's what she would like to see before making a decision. What does it look like if she funds a policy for 3 years, then takes loans for 3 years to pay for her son's college tuition? And then option one, show me what it looks like if I don't pay anything toward that loan. No principal, interest, nothing. That's what I'm really interested in seeing. Then show me what it looks like if I pay interest only, and I would like to see what it looks like if I pay the loan back. I'd like to see exactly how my money continues to compound for me. So we're going to look at that in detail. However, here's a question that often comes up. Can my child pay the loan back? Or does it have to be me? The answer is yes, your child can pay the loan back. And this is actually popular when using a policy to pay for your child's college tuition. And here's often how it's viewed. If they pay that loan back, your cash value is restored, and it also restores their future inheritance. because this is a life insurance policy, which means the life insurance benefit will be paid out. And if they're a beneficiary, that means they're going to get that money. So if they pay it back, they'll see the death benefit restored, which will eventually go to them. However, if they don't pay it back, well, then what happens? The cash value is reduced, but the death benefit is reduced as well. Some parents can view this as money that will eventually go to their child, but they'll say, if you pay it back, you will see your future inheritance restored, and it will be worth a lot more than what you pay back. But if you don't, it will reduce the amount that you will eventually receive. And they can pay it back like they're paying back a traditional student loan. Some parents like to structure loans like that with their children, or they can just pay it back however and whenever they want. Let's take a look at the numbers, shall we? So all of the numbers are based on these illustrations. We've got a MassMutual 10-pay policy. So MassMutual is one of your 4 major mutual companies, which just means we've seen consistent proof of performance when we look at their illustrations compared to the actual results. And we have one of their strongest cash value products, which is their 10-pay policy. So again, this is on a 54-year-old doctor. It is a female, and she is funding $125,000 per year for 3 consecutive years. After that, she has the option to continue to fund, but we're assuming she never pays anything else in. So this shows what the policy looks like with no loans, just paying money in and letting it sit and grow. So here's the growth illustration. Then we have the illustration, loans coming out and not making any payments, loans coming out and paying interest only, and then loans coming out and repaying the loan in full. I know these illustrations can be confusing. If you want to proof the Excel workbooks I'm about to pull up, I would just look at the cash value column here, and you'll find that all of the illustrations match everything that we have on Excel. So let's get into it. What we'll start with is the growth illustration. So again, this is a MassMutual 10-pay policy. The dividend rate is 6.60% for 2026, and the loan rate is based on January's loan rate. It is a variable rate, and for January, it is 5.33%. So we've got the total funding of $125,000 per year. You can see the minimum premium, which includes the base premium, plus the cost of the term insurance rider, and then the rest is going toward PUAs. Your bottom line is $125,000 per year. Then you can see the total amount she has paid into the policy, the total funding column, and then to the right of that is the cash value. What's highlighted in yellow represents the break-even point, meaning at year 3, she's paid in $375,000, her cash value is $370,000 and change. She has not hit the break-even point yet. And then year 4, her total input is still $375,000 and her cash value is just about $388,000. So that is the break-even point. There's the cash value and death benefit, but what is it actually growing by? We mentioned that the dividend rate is 6.60%. Is that what the money is growing by? It's not. If we were to calculate the true year-to-year rate of return, you would never see it earn 6.6%. What we would want to look at is our annual rate of return, which can also be referred to as our annual yield. And this displays the true net growth rate year over year. Why this is important to look at is if you are a numbers person and you're comparing what is my money growing by compared to what am I paying in loan interest, this is very important on a year-to-year basis. Because you can see early on that it's going to hurt more than it helps. But long term, it feels pretty good. But it's very important to analyze this in detail. Then we've got the internal rate of return, which is really just a fancy way of looking at our long-term average growth rate, in my opinion. Okay, so numbers look good long-term. It is based on the current dividend interest rate. Let's take a look at our loan illustrations. To the left, you've got the same growth illustration we just looked at, 125 for 3 years, and instead of having the annual yield and internal rate of return, I'm going to include the growth in dollars. This shows the cash value growth year over year. But what we want to compare this to is the loan scenario. What does it look like if I borrow and don't pay anything back at all? Here are our 3 $100,000 loans to pay for her son's college tuition. There's the loan balance. What's happening here? It's compounding. Why? Because we are assuming no payments at all. We're not paying the interest, principal, nothing. So what happens is if you get a bill for the loan interest and you do not pay it, what will happen is that the policy will take a loan against itself, specifically against the available cash value, to pay that loan interest. And because it's taking a loan against the cash value, that is what results in the loan balance compounding. And the important thing to make sure of here is that the loan interest does not exceed the total interest earned. The easy way to look at this is to look at what's my cash value if I pay 0 in and I don't pay any loan interest. And does my cash value go up or down? If it goes down, that's a problem. If it goes up, that's a good thing. It's not a problem. Now, you can also stress test this further by looking at a lower dividend interest rate or a higher variable loan rate assumption, meaning test it, see what things look like in a less favorable environment. As we look at this guy, this looks good, meaning the cash value keeps on growing if she pays nothing in. And effectively, what's going on here is she paid in $375, she pulled out $100, so she feels like I paid in a total of $75,000, and I've got more than $75K long-term, and I also have life insurance of several $100,000, and it continues to appreciate over time as well. So a lot of times people will look at it that way, and if you really like the numbers, what you can look at is the cash value growth, compare that with the loan interest, and line by line, see if your growth exceeds the cost to borrow. And what you can look at is your true net spread, which we see right here. And why we're outpacing the loan interest, because you might recall that annual yield is less than the loan interest rate during the first 7 years. The reason why is because this cash value growth is based on the entire cash value, borrowed and non-borrowed, which is the number to the left. Whereas the loan interest is only based on the outstanding loan. So we've got a larger bucket of money compounding for us relative to what we're paying in loan interest because we're gradually taking those loans out here. But I just want to see this in the black, not in the red. If we look at paying interest only, here we go. Same scenario. There's your 3 $100,000 loans. There's your loan balance. It is not compounding here because we are assuming that you pay the loan interest annually. First year is $53.30 because the loan interest rate is 5.33%. Then you can see the cash value and death benefit over time. Why it drops, by the way, that death benefit after year 7, a lot of times people ask about this, is because we removed the term insurance rider. A term insurance rider is used to prevent what is called a modified endowment contract, or a MEC, which is a taxable event. We wanted to make sure we could still access the cash value tax-free, which we always aim to do. So looking at paying the interest only, what we've got here is a pretty good looking scenario in my opinion. This stuff is fun, isn't it? So look at this. There's your cash value growth. There's your interest payment. And then the net result really just shows the difference between the two. So for example, by the 10th year, the policy grew by $27,000 and change. You paid just about $16,000, which means you're ahead by about 11.3 in this example, which is quite nice. Now let's look at the finale. What does it look like if I pay it back in full? Here we go. So, growth illustration to the left. To the right, we've got our 3 loans of $100K per year. There's your loan balance. There's your loan interest. What you will notice here is for the first 3 years, or really the first 2 years here, when the loan interest is billed, she's not paying it. Meaning she wants to fund for 3 years, take loans for 3 years, and then after college is over, if her cash flow permits and she wants to, then she will pay back the loan. In this example, we're assuming that she does that at $50K per year. And what you can see in this model is of that $50,000, how much is applied toward interest, and then how much is applied to the loan principal. And then we see the cash value and death benefit. Here's the point I want to hit on. When you look at the bottom of the screen, at her age of 65, the example to the left that is highlighted in that beige color, what do you see in terms of the cash value and death benefit figures? 585 and about 825. What about to the right? Huh? They're exactly the same. Remember that point we mentioned earlier where your money continues to compound even though a loan's outstanding? So she put her money in the policy, then used the money to pay for college. She kept on getting this growth all the way through. So a big benefit that a lot of people see with these products is knowing that if they pay that loan back, their value is going to be restored to what it would have been as if they never touched it in the first place. There's no lost opportunity cost. I receive the constant compounding. A lot of people like that. When I look at the net results, here we go. Cash value growth, loan interest, and net. Looks good. As I pay that loan interest down, what happens? That spread gets stronger and stronger. And then once it's paid in full, we can look at the long-term results as well, where now that net result is just what your money is growing by each year. So to recap, why do people do this? Some do it for financial aid. However, that does depend if they qualify for financial aid, if they're in a position where that actually makes sense for them. But then the second reason, which is the popular one with most people we speak with on a regular basis, is the fact that their money keeps on compounding. And when you layer the tax-free benefit, being that you can access the cash value tax-free if you do everything right, that really attracts people, especially someone like this who's in a higher tax bracket and they live out in California. They're getting killed with taxes. Her and her husband are doctors, so they're getting killed every year. So that does make the product very attractive in that respect. And then how it works, I put money in, ideally for a short period of time. I take the money out and I request to see up front, what does it look like if I don't pay it back or if I pay it back partially or fully. I hope you enjoyed this video. If you did, please let me know your thoughts below. And as always, I hope this helps.